Okay. Well, nice, not a day. Realmente llegó a esa zona. Mm, mm, mm. Mm, mm. Let's see.
Character, then we will have no trade. Strategy, you need to know several smart money concepts, such as order block, break of structure, and change of character. To fully understand these concepts,
Do you know why most traders lose money in the market? It's because they jump in, without a solid trading plan. That's why today, we're going to show you a powerful day trading strategy, a smart money trading plan that guides you from starting your analysis till entry, with mechanical rules to be followed. Whether you're struggling with entries or taking losses too often, this strategy will give you a clear edge over the market. So, before you take another trade, make sure you watch this till the end. This trading plan is a day trading strategy, which means traders open and close their positions within the same day and do not hold their trades for the next day. This strategy prevents overnight risks and focuses on capturing short-term price movements. Low. Day trading offers a balance between swing trading and scalping, making it a great choice for traders who want frequent trade opportunities without the extreme fluctuations of scalping on lower time frames or the overnight risks of swing trading. It also works well with smart money concepts, allowing traders to apply precision entries based on liquidity, order blocks, fair value gaps, and market structure concepts. The price to move away sharply from that level. Normally, we mark the beginning of this sharp move as the demand and supply areas, and we expect the price to reject this zone when it revisits it, because of the behavior of market participants. However, there are several key factors to consider when identifying valid supply and demand areas for trading: inefficiency, break of structure, and the push distance. Each of these concepts serves as a critical clue to help confirm the strength and reliability of the zone. Inefficiency occurs when price leaves an area quickly, creating an imbalance between buying and selling orders. This imbalance is identifiable through fair value gaps left between consecutive candles. These gaps suggest that there is a lack of supply or demand at that level, making it a potential turning point. Break of structure, BOS, happens when the price moves past a key support or resistance level, indicating a shift in market sentiment and confirming the potential strength of the supply or demand zone. Every time price breaks a structure level, it signals a potential trend continuation. The push distance refers to how far price moves away from the zone before returning. A larger push distance often signals a more significant rejection, making the zone stronger. By considering all these factors together, you can more effectively identify high-probability supply and demand zones for your trades. Here is an example of a high-quality demand zone. If we draw the zigzag lines on the Euro-Dollar 1-hour chart, we will see highs and lows marked like this. The latest impulsive movement meets all the criteria for a high-quality zone. It has created a fair value gap, broken through the previous market structure, and pushed the price higher by a significant distance compared to previous moves. Once the price retraces back to this zone, there is a higher probability that it will reject this area and continue moving upwards. But what happens if the price breaks and closes below this high-quality demand zone? This would indicate that buyers have failed to hold the level and sellers have taken control. It signals that the uptrend is over and a potential reversal is underway. So, when price breaks through a high-quality level like this, we can confidently say that the market structure has shifted and the momentum is now favoring the sellers. This condition is known as a change of character, signaling a shift in market sentiment. The change of character is valid except in two common scenarios. Sometimes the market structure conditions make these changes invalid. Let's break this down step by step. Right here, we have a major swing low that triggered this breakout. A break below this level might seem like a valid change in character. However, if you look at the left-hand side, you'll notice something crucial. This level aligns with a significant area of liquidity. Here's the deal. Many traders previously opened long positions at this level, placing their stop losses just below it. What does this mean? A massive pool of liquidity is sitting beneath that level, waiting to be tapped. Now, smart money knows this. To hunt these stop losses, they often push the price lower, sweeping the liquidity before driving it back up in the same bullish direction. Here's the key takeaway. When a major swing low sits in a liquidity hotspot, breaking through it is often just a liquidity grab, not necessarily a signal of a market reversal. In this context, we can't classify this break as a valid change in character. If the price re-enters the range after the liquidity sweep, it creates an excellent opportunity for a long position. Why? Because the overall trend remains bullish, the sell-side liquidity has been engaged, and the next target is the buy-side liquidity. As smart money traders, our goal is to enter after the stop losses are taken out, when the real move begins. Now that's just one piece of the puzzle. Let's talk about another concept that can also invalidate a change of character: the mitigation of fair value gaps. As a smart money trader, identifying FVGs should be one of the first steps you take when analyzing a chart, because these zones often act as magnets for price. In most cases, before continuing its trend, the market pulls back to fill these gaps. This is why FVGs are critical zones to watch. They're most effective on intraday timeframes, such as the 4-hour, 1-hour, or even smaller timeframes. Now here's where it gets interesting. Let's go back to the earlier example. Look closely at the left-hand side, and you'll spot an unmitigated fair value gap sitting just below the major swing low. In scenarios like this, price often retraces to the FVG zone to fill the gap. This pullback doesn't indicate a true reversal. It's simply the market rebalancing itself. The bottom line? Always check the left-hand side of the chart for unfilled FVGs. This helps you distinguish between a move that's just filling a gap and one that reflects a real shift in market sentiment. By doing this, you can avoid false signals and stay aligned with the bigger picture. With all being explained, let's move on to the next topic: supply or demand. Who is in control? Identifying the market direction is the first step in analyzing a price chart. The goal is to determine the trend and see whether buyers or sellers are in control. Trading in alignment with the dominant side increases the probability of success. How does the system work? The system operates on mitigations. When price mitigates a demand level, demand takes control over supply. Conversely, when price mitigates a supply zone, supply takes control over demand. I know it sounds so basic, but it all will make sense in a minute. Imagine the market is in an uptrend, forming a series of higher highs and higher lows. Each time price breaks structure to the upside with inefficiency, a demand zone is created. These demand zones remain unmitigated until price revisits them, offering ideal opportunities to trade with the dominant trend. However, if price breaks below a valid demand area, it forms a change of character. This signals two key things. First, supply has taken control over demand. And second, a new valid supply area has been established. From there, price continues moving downward, forming new supply zones until it reaches the next unmitigated demand area. At this point, a battle between supply and demand occurs. Sometimes this results in consolidation and a ranging market between these two zones. A break above or below the range will determine which side gains control. The next concept we'll explore is order blocks. But before we continue, if you're an experienced trader looking forward to getting funded, register with our trusted prop firm, Funded Next. On the chart where significant buying or selling pressure originated. These zones are critical because they represent areas where institutional traders or large market participants likely entered their positions, driving the market in a specific direction. We identify the first candle that caused a fair value gap area on the chart as the order block zone. This is because we believe the decision behind the strong move originated somewhere within this zone. When the price eventually returns to this area, there's a higher probability it will react. However, this reaction depends on whether unfilled orders still remain within that zone. It's important to note that order blocks don't always work. They aren't guarantees, but rather potential trading areas where price may show predictable behavior. Like any tool in trading, they should be used in combination with other confirmations and strategies to improve their reliability. Finally, we have top-down analysis. This technique is all about combining multiple timeframes to get a complete understanding of the overall market conditions. By analyzing the bigger picture on higher timeframes and then zooming in on the smaller timeframes for finer details, traders can identify the most promising trading opportunities. The process begins with the higher timeframes, such as the daily or weekly charts, to determine the broader trend, key levels, and market sentiment. These larger perspectives help us understand where the market is likely headed. Once the bigger picture is clear, we shift to lower time frames, such as the 4-hour or 1-hour charts, to pinpoint precise entry and exit points using our trading concepts. The important point here is that we never want to overcomplicate our trading, so we're only going to apply the concepts discussed in this video to the charts. Let me show you how. Here, we have the dollar-yen on the daily time frame. In this higher time frame, the only thing we want to mark on the chart is the key supply and demand zones near the current price. At the top, we have the recent high, and at the bottom, we have the recent low on the daily chart. These levels are important because if we zoom into the lower time frames, we'll notice that these prices have been turning points for short-term trends. So, once the price reaches these levels again, we can expect a possible rejection. We can also notice something else if we focus on the latest impulsive movement. It has created a bearish FVG, so we can mark the candle responsible for this imbalance as an order block. This bearish order block is a good spot to look for a selling opportunity. Right now, the price is at this level. However, the daily chart is not our entry time frame, so we need to zoom into the lower time frames such as 4-hour and 1-hour to look for confirmations and a possible short opportunity. Overall, the higher time frame is bearish, and there's still enough space before the price reaches the next important zone. This is all we need from the higher time frames to identify the overall market sentiment and mark the key zones. Now let's zoom into the 4-hour chart. Again, the only thing we need here is to identify the market direction and mark the key levels on this higher time frame. The market direction is a smooth downtrend, respecting lower highs and breaking lower lows one by one. This gives us a noticeable support level to mark on the 4-hour chart. The analysis is the same as on the daily time frame. The market sentiment is bearish, and we are looking to take a short entry to stay aligned with the dominant downtrend until the price reaches the important levels ahead. However, there is still no strong reason to enter a trade at the daily order block. So let's zoom into the 1-hour chart to see more details and find a good entry. On the 1-hour chart, things get interesting. Unlike the higher time frame, the direction here is bullish. The latest impulsive move has created an imbalance, which shows strong demand power. We mark the candle responsible for this imbalance as our order block zone. To refine it, we can also include the wick of the next candle in this zone. When the price reaches this 1-hour order block, we expect a battle between supply and demand. If the price breaks and closes below this order block, it means supply has taken control. On the other hand, if demand wins, the price will rise and may even break above the daily order block. Now let's see what happens next. The price breaks below the 1-hour order block, showing that supply has taken control. This is a strong sign that the short-term uptrend is over and that the price can continue moving lower in line with the higher time frame direction. So where do we enter the trade? We wait for the price to create new bearish order blocks. Set your sell limit at the order block and place your stop loss above it, giving the price some room to breathe. Take partial profits when the price reaches your 1 to 2 risk to reward target and aim for the key levels ahead to maximize your trade. Now here's an important point. Patience is one of the most valuable skills you can develop as a trader. Waiting for high-quality trade setups to form in the market is not just a choice, it's a discipline you must master. Many traders, especially beginners, fall into the trap of overtrading or rushing into positions because they feel pressured to always be active in the market. However, successful trading is about quality, not quantity. Now let's see another example. Here on the Euro-Yen daily chart, let's mark the key levels. At the top, this is the highest price reached recently and was rejected. At the bottom, this could be a potential support level when the price taps into it again. Also, we have this level that has acted as support and resistance multiple times. So, we mark it in. Right now, the price has broken below this level, so we expect it to drop to the next level in front of the price. Now let's zoom into the 4-hour chart. On this time frame, we can see a smooth downtrend, confirming that the higher time frame direction is bearish. This means we only want to look for selling opportunities. Right now, The latest move has created an imbalance, and we can mark this candle as a potential supply area. We should also add this wick to the order block zone, because this is the start of the imbalance. This makes our trading zone a large area to look for trades. However, if the price returns, we expect a rejection somewhere inside this zone. First, we wait for the price to enter the zone, and then move to the 1-hour chart to refine it and look for short trading opportunities. On the 1-hour chart, we focus on identifying order blocks and placing our sell limits. Here, we can refine the 4-hour order block like this. However, we can't take short entries yet, because, although the higher time frame is bearish, the 1-hour structure is still bullish. We need to wait for this short-term bullish uptrend to end before looking for selling opportunities. Now let's observe the price movements. At this point, the price has confirmed a change of character, signaling a reversal. Additionally, it has formed an order block, which we can use as our entry zone. With both the higher time frame and the lower time frame now bearish, we can confidently take a short entry. The 1-hour chart serves as our entry time frame in this strategy, allowing us to refine our trades and achieve more precise entries. However, if you prefer to go even deeper, you can zoom into lower time frames, such as the 15-minute or 5-minute charts, to look for additional confirmations. This can help you enter trades at an even better price, improving your risk-to-reward ratio. It's important to note that in this analysis, we did not incorporate session volume or news events. These factors can significantly influence price movements, especially during major economic announcements or periods of high market activity. Incorporating session volume can help you identify the times when liquidity is highest.
Good. Okay, that is a good explanation. It is the end for the rest of the day.